The session is about to start. I don't know if all the speakers are here. But Bastien? Okay, perfect. Okay. So I guess without further ado, we can start. So we are going to have 3 papers this morning for a session of 1 hour and 30 minutes. So it's going to be 30 minutes total per paper. So I guess it's 20 minutes for the paper and 10 minutes for the discussant. And for the first paper, we are happy to welcome on stage Baptiste, Perez, Riaza for a talk on spillovers effects of Tether Depegs on Bitcoin gems and crypto markets Cojumps. Thank you, Baptiste.
Je ne sais pas s'ils le font eux automatiquement, mais je sais pas. Okay, thanks for the invite. So I'm Baptiste Perez. I'm a final year PhD student at the University of Namur. So this is a joint project with Jean-Yves Gnabo, who is my supervisor. So this project mainly tackles Tether Depegs and their impact on the crypto assets market more generally and Bitcoin more specifically. So first, let's define what a stablecoin is for those who don't know. So basically, it's a token on the blockchain that tends to represent another asset. So in most cases, it's USD, so US dollar. And so the main aim of the stablecoins is to maintain the peg throughout time, to have sort of a stable asset in the crypto asset sphere. So this is one of the first usefulness of stablecoins, is to have a potential asset that is stable in the portfolio of crypto holders. But also it is sort of to have a digital representation of the US dollar on the blockchain, which is then used in a lot of decentralized finance protocols. So mainly for loans, but also if you look at different exchanges, it's one of the main trading pair to buy Bitcoin or other crypto assets. So it's really one of the main tools in the crypto asset sphere to exchange, to do different types of financial products on the blockchain. So it is becoming huge in the market. So this is just until 2023, but right now it's about 200 billions in terms of market capitalization if we take all the different stablecoins all together. And so you have different types of stablecoins that have different risks that are entitled to those stablecoins. And so in this paper, we mainly focus on fiat collateralized stablecoins, so Tether, which is the biggest one. And basically how they maintain the peg is to hold collateral that is tied to the value of the asset. So they mainly hold government bonds and cash, so they want to have very liquid assets that in case if you want to retrieve your euros or dollars in this case, they will be able to sell those assets to get the collateral back. And so there are different types of risks in those assets. So basically counterparty risk, because it is a company that is behind those stablecoins, and so they must maintain the peg at all price. Also collateral risk, because all the collateral have some value, and so if there is the devaluation of those collateral, there might be some risk that the peg doesn't hold that we've seen. Of course, regulatory risk that we've seen with MiCA. For instance, Tether in this case is almost impossible to trade on European platforms because they do not, they don't follow the regulation that were just put in place recently, which USDC follows. And of course, liquidity risk that is entitled to all those kind of stablecoins. And smart contract risk for Tether is less of a risk because the smart contracts are kind of basic in the Tether case. And so based on those risks, we've seen several Depegs that occurred. So the major ones were the ones of USDC, which was temporary because I don't know if you recall. So basically a big part of the collateral was held in Silicon Valley Bank that basically went bankrupt. And so investors in USDC kind of feared that USDC wouldn't be able to retrieve the deposits in the Silicon Valley Bank, and so basically they couldn't hold the peg anymore. But once the government kind of reassured the market that all depositors of Silicon Valley Bank will be made full, then we see that the peg just went back to one USD. And then we've seen, of course, Terra Luna, which is kind of another type of stablecoin, but which completely depegged and is basically worth zero right now because it was kind of a shady project in this case. And so there are different factors that kind of provoke those depegs, but what I want to really emphasize here is that depegs can happen on both sides. So it can depeg on the downside, but also on the upside, as we've seen through, for instance, when the Ukrainian and Russian war started, some investors in Ukraine wanted to get their capital out of the Ukrainian market. And so we've seen in those types of exchanges in Ukraine that basically stablecoins tend to trade at premium because they wanted to get their capital all out of those countries. So basically it can depeg on both sides, and we are going to take into account both sides of the depegs. And so there are different reasons for which it can depeg on both sides, and mainly the downside is linked to the risk that I just previously explained, but it can also go on the upside with capital influx or flight to safety behaviors that we've observed. So most of the time it's based on an imbalance between the demand and the supply in the secondary market, and the volatility tend to increase that leads to the depegs. And what I want to focus here, or at least put emphasis on, is that basically the depegs can also happen because of other crypto assets in the market. So studies have shown that the volatility of Bitcoin can also impact the volatility of other stablecoins. So that is one thing that we need to take into account in our study here. So the main research questions that we want to tackle in this project is basically what are the spillover, or at least what are the consequences of Tether depegs on the probability of observing jumps in Bitcoin and on the crypto asset market in general. So we have three kind of hypotheses that we want to focus on. The first one is that we tend to think that stablecoin depegs increase the likelihood of observing jumps in the crypto asset market, and that those jumps tend to be larger than in normal conditions, which when we say normal condition or stable periods is when stablecoins are holding their peg. And finally, the last hypothesis is that negative depegs will tend to have larger jumps than positive depegs, because we think that the negative depegs tend to input fear in the market that will lead to have bigger jumps in the market. So first, we need to define, of course, what a depeg is, because if we take the simple definition, it's just a significant deviation from the 1 USD peg. But what is significant? So we need to input some kind of rules in there to detect those depegs. So we set some predefined thresholds. Once the price goes below or above that threshold, we will consider that as the start of the depeg, and it must hold at least 10 minutes the depeg. And if we observe one depeg that occurs after 20 minutes of another depeg, we will consider that as one, because otherwise we will consider the start of a lot of depegs when in fact it is just one. So this is an example of our mechanism here. So before the green dots, we do not detect that as the start of the depeg because it doesn't hold enough time below the threshold. And so it only starts when we have consecutive observations that are below the defined threshold. So we also make a robustness test where we basically go back to the first time that the price depegs, or at least is not equal to 1, to make sure that we do not detect too late the depegs in our case. So we have two types of depeg detection mechanism. So that is for the depeg part, and then we want to see the impact on the market through individual jumps. So what we are going to do here is basically we define a jump diffusion process where we have the drift, Then we have kind of the volatility part, and then we have the jump part. And what we want to detect here is the jump part of the market, which are basically extreme events that occur on the price process. And so to do that, we basically rely on the Lee and Mickland methodology, which is widely known in the literature, which is the absolute returns divided by the stochastic volatility. But what we've observed in the market, which is also valid for basically traditional assets, is that we have a periodicity in the volatility of the Bitcoin. So basically the volatility of Bitcoin is not the same during different days of the week and also during different hours of the week. So that's what we see, well, not that well, but that's what we're supposed to see in the paper, is that around 3 to 4 p.m. in Europe, the volatility tends to increase compared to other hours, because that is the same. I mean, we have the US that is trading as well as Europe, so we have multiple markets that are trading at the same time. So we need to take that into account. And so that is why we use the methodology of both and all to detect those jumps, where we include this periodicity in intraday volatility in the computation of the statistic to detect jumps. And so that is how we detect the individual jumps for Bitcoin. And then we also want to observe the effect of Depegs on the broader market in general. And to do so, we will detect the Cojumps using the Bolerslev and all methodology. So Cojumps are basically jumps that occurred in multiple assets at the same time in this case in the crypto asset market. So that is the tool we're going to use to detect the broader crypto asset market jumps. And so once we have, on the one side, we have our Depegs, and then on the other side, we have our jumps and Cojumps, we are just basically computing conditional probabilities and simple probabilities to observe the likelihood of observing jumps or Cojumps after a Depeg. So we have our conditional probabilities on Depegs, and then we have our unconditional probabilities, where basically the no Depeg sample are days during which we have no Depeg at all. So if we detect just one single Depeg during a day, we get rid of all the day to make sure that we have stable coins in this case in our control sample. And then we make the null hypothesis that if the conditional and unconditional probabilities are equal, that will suggest that Depegs do not have any effect on the jump probability in our market. So that is what we do. To do so, we gather the prices of 70 non-stable crypto assets priced in USD. So we get rid of all the wrapped assets and assets with frequent missing data. So wrapped assets are assets that such as Ethereum or Bitcoin that are issued on other blockchains, but basically it's the same thing, it's the same price process, so no real use cases here. And we also take the trading pair of USDT against USD. And we take that at a high frequency of 5-minute observations between January 2023 and June 2023. And so those are basic descriptive statistics here of the jump process of Bitcoin. We are mainly going to focus on Bitcoin here. And we see that for 546 days, we have more than 1,000 jumps that are detected. So it is a very, we'll say, jumpy price process here for Bitcoin. And that is in accordance with the literature. And so basically we have 88% of the days during which we detect at least one jump in the Bitcoin price. But if we take at all the observation, it is less than 1% of the observations that display jumps. So it is very, big tails in the distribution of returns in the Bitcoin and also for Ethereum and the other assets. And now if we look at Depegs, so what we are going to use as a threshold in this study is the 0.5% deviation. So if the price is below 0.5 deviation, we will consider that as the start of the Depeg. So that is in accordance with the money market funds that basically consider that they break the buck when there is a deviation of 0.5% in the money market funds. And we observe that mainly a large part of the USDT Depegs are actually on the upside when we consider that threshold, with more than almost 200 Depegs on the upside and only 40 observations on the downside. So we have a huge sample of Depegs in here, and also the period that we consider, so 2022 to 2023, was the case of a lot of Depegs that with major Depegs actually on different stablecoins, so it's an interesting period to tackle here. And so what we observe in this study for the first hypothesis, that is stablecoin Depegs tend to increase the likelihood of jumps in the crypto asset market, we observe that for both Bitcoin jumps and Cojumps, there is 35 times more probabilities to observe jumps in those markets. So basically, if we only focus on Bitcoin, we have, after a Depeg, a 25% chance to observe a jump in the Bitcoin market, whereas it is only 0.43% when we focus on the control sample. So it is 35 times higher in terms of probability compared to the control sample. And that lasts for about 4 hours in our observations. But only doing that can have potential issues, which is, as I mentioned in the motivation part, that basically Bitcoin volatility can impact the stablecoin pegs also. So there might be some reverse causality issues only by focusing on that. And also there might be some macroeconomic news that act as confounding effects. So basically the macroeconomic news can have impact both on the Depeg, or at least on the peg of Tether, and on the price, or at least the jump process of Bitcoin. So to make sure that we control for that, we first get rid of all the high volatility Bitcoin days. So we basically compute the volatility, the daily volatility of Bitcoin, and we only take the days during which we have a volatility lower than that mean. And when we control for that Bitcoin volatility, the results stay robust. So we still have a huge probability of observing jumps in Bitcoin after Depegs, even when the Bitcoin volatility is low in those days. And when we take into account the macroeconomic news, so for that part, we basically get rid of all the days during which we observe jumps in the traditional market. So we hypothesize that if we have an unexpected macroeconomic news, that will most likely trigger jumps in the traditional markets. And so we get rid of all the days during which we observe jumps in the S&P 500 and in the treasury bonds, and we compute that conditional probability to observe that. And we see that the results stay robust, even though they are way lower than previously. It's still 5 to 6.3 higher than the control group. So that is for the likelihood of observing jumps. And then we also try to find if those jumps are larger during Depegs than during stable periods. And we observe that for both positive Bitcoin jumps and negative Bitcoin jumps, the mean and median of those returns that are linked to those jumps are higher than in the control sample. And if when we perform the Wilcoxon test, we see that the distribution of returns during those jumps are different between the Depeg sample and the non-Depeg sample. So those elements tend to indicate that indeed the jumps that follow a Depeg are larger in magnitude compared to the jumps that occur in stable periods. And finally, we also compute large jumps. So as I was showing previously, we compute the jump using the Boughton methodology. And so we need to take a certain alpha to make sure that we are confident in our results. So we basically have a higher alpha, or lower in that case, so 0.01% instead of 1% alpha, to make sure that we only capture the largest jumps in the market. So we compute those jumps by making sure that we have the most significant movements. And so we have those large jumps, and we compare those large jumps between the negative Depegs and the positive Depegs. And we see that there is a higher likelihood of observing those large jumps after a negative Depeg than a positive one. So it tends to indicate that, in fact, negative Depegs have a larger impact on the jumps than positive ones. And those jumps are likely to be larger when it's following a negative one than a positive Depeg. So that is all. So to conclude, what we find in this study is basically that Tether Depegs tend to increase the likelihood of observing jumps in the market. So in fact, stablecoins have an impact, or at least when stablecoins depeg, that have an impact on the likelihood of observing jumps in other assets in the crypto asset market. Those results tend to be independent of the volatility of Bitcoin and the volatility and the macroeconomic news. And those jumps are larger in magnitude and are even larger when following a negative Depeg. So all this to say that basically if regulators or people at the European Commission are maybe reading this, I don't know, they clearly need to make sure that stablecoins have a resilient design, and that collateral that tends to create the peg needs to be held in very safe institutions, because as we've seen with USDC, when the collateral is held in banks that go bankrupt, it can have huge impact on the market. And so we need to take that into account and make sure that those stablecoins are very robust in their design. So thank you for listening, and thank you to the organizing committee for inviting me. I hope you enjoyed this presentation. Thank you.
There's going to be the discussion of the first two papers at the same time. So I propose we move to the second paper of this session, and then we'll do the discussion and the Q&A after the second presentation. So I leave the floor to Romain Rossello from HEC Paris. He's going to talk about blockholders and strategic voting in DAOs governance. The floor is yours, and you have 20 minutes.
Okay. So thanks a lot for inviting me and for including the paper in the program. So today I'm a PhD candidate in the finance department of HEC Paris, and today I'm going to present my paper about basically the governance of DAOs. All right. So first of all, a little reminder of what are DAOs. So DAOs stands for Decentralized Autonomous Organizations, and they are organizations, loosely said, in the blockchain space that launch a product. And so this product can be a blockchain of itself, it can be a platform on an existing blockchain, it can be an NFT collection, it can be a stablecoin, as you've seen before, it can be a lot of things. Now, what's important is that they aim at having users involved in every governance decision to further develop that product. What's also very important is that each DAO has its own governance token. And basically the voting power that you have on the decision is weighted by your governance token holdings. Now, because they aim to really involve their users in the governance, there is high frequency voting. And the nice thing that you have when you look at DeFi is that you have highly granular voting data that are available. Right. So in this paper, I will focus mainly on DeFi DAOs. So among all of the products that I've talked about before, those are decentralized organizations that aim at launching new financial intermediation platforms. So think of decentralized exchanges, think of decentralized lending. And why do I do this? It's because their governance tokens look the most like shares. And so they are starting to be, those specific decentralized finance DAOs are starting to be economically significant. And when you look at the content of their proposals, the content is very similar to traditional corporate governance. Basically, they are going to vote on compensation of key members. They are going to vote about financing projects through token issuance, which looks a lot like equity issuance. And therefore, the conflicts of interest that are going to arise between majority shareholders and minority shareholders are the same as you would have in traditional firms. So in this space, it's going to be called majority token holders and minority token holders, but it's basically the same thing. And I won't delve into it today, but some DeFi DAOs even start having payout policies, such as token buybacks, which of course looks a lot like share buybacks. All right. So if you're a corporate finance researcher like me and that you have this very granular data on voting that are available, much more granular than you have in traditional corporate governance, you would like to apply either corporate governance or corporate finance to those data. Now, one motivation to do so is that, as I said, the content is similar, but it's not enough. So today I'm going to show that you have strategic behaviors of agents and that those agents act strategically according to their stake, which is exactly what you would expect from agents in traditional finance. Basically, if there's an opportunity or a private benefit to be seized, you expect this opportunity to be grasped, and that's what's going to happen here. Also, you expect new information about governance and about governance risk to be incorporated correctly in governance token prices. What do I mean by correctly is that, first of all, it's going to be incorporated in governance token prices. And the second is that it's going to be incorporated only the first time that the event happens. So you don't want to have voters and participants that keep getting surprised by the same event. That would not happen as in traditional finance, and I'm going to show that this is also exactly the case in DeFi DAOs governance. And then you also expect blockholders, and I'm going to be very precise about what is a blockholder in this context, to have a positive impact on governance that has basically nothing to do with information. And again, I will be very precise on the economic mechanism here. And so the question that then asks itself is, can DeFi be a valid laboratory to study corporate governance? And I'm going to argue that yes. All right. So I've talked about new information incorporated in governance token prices. What is going to be new information here about governance is going to be the first occurrences of two types of strategic voting interactions for each DAO. So the first time that you have a majority voter that votes unilaterally against what minority token holders would have had chosen, it triggers basically an 11.7% drop in weekly abnormal returns. The first time that you have a blockholder, which is, let's say, non-pivotal, that benefits from a last mover advantage that then becomes pivotal, this is going to trigger a 7.5% drop in abnormal returns. You're going to have subsequent strategic voting interactions that don't trigger these returns. So it's nice because voters don't keep being surprised by the fact that there are majority voters and blockholders acting strategically. And you're going to have blockholders' presence that is overall positive relative to proposal without them, and they are associated with positive returns of positive weekly cumulative abnormal returns of almost 2%. All right. So the data that I look at is basically the data that I retrieve from Snapshot, which is an off-chain platform where all the votes from DAOs happen and from DeFi DAOs happen. Those are I'm going to focus only on closed proposals that have approval voting. Most of the DAOs follow a one token, one vote voting rule, which is very similar to what you have for shareholders. Some use delegates, and the sample that I have is basically from the launch of the platform to the 1st of September 2022. And this period is very important because during this period, votes are visible during the proposal. So another way to say it is that you have the live scores of the proposal if you wish to see it. Now, you also can't purchase token to improve your stake during the proposal. And what I want you to take away from that slide is that the data that you gather from the DAOs is very granular. So you see what address has voted for which choice, when do they have voted, and with which voting power. So this is unprecedented in corporate governance. Normally you have a report of a general assembly, you see the overall scores of many proposals. This does not happen like this. All right. And so in the final sample, you have 75 DAOs above 1 million votes. And as I said, the DAOs are decentralized exchanges, decentralized lending, stablecoins, whatever. All right. So I'm going to isolate two types of votes from the voting data and their strategic counterpart. And what is nice is that I can identify the strategic counterparts because of the granularity of the data. So I'm going to call a majority voter a voter that basically unilaterally chooses the outcome of the proposal. It has more than 50% of the overall voting power in the proposal. Now, this majority voter can vote as minority voters, or it can vote against. And I'm going to call a swaying majority voter a majority voter who unilaterally chose to go against minority voters and against what they would have had chosen. And I'm able to identify those because I know the choice that's being made by every address that votes. I'm going to call a blockholder basically the other side of the coin, which is a substantial voter that has a voting power between 10% and 50%. And so this voter is not pivotal, right? It cannot unilaterally choose the outcome. However, if the outcome is tight and he or she waits until the last moment, it can become pivotal. So I'm going to call a sniping blockholder a blockholder that waits until the last time to vote. And again, I can identify those because I have the timing of the votes, which normally I wouldn't have in corporate governance. All right. So what does a typical DeFi DAO look like in this sample? So basically, you have 80 proposals that are going to last 5 days. They gather 224 voters. And what you can see is that the number of contributions that it takes to get to 50% of the overall voting power in the proposal, on average, is 5.3. So I focus on decentralized finance, decentralized autonomous organization. You can see that it's not that decentralized. So for DAOs which have delegates, it's not that surprising, but for the others, DAOs are actually quite centralized. The market capitalization at the time of the sample for the average DAO is $300 million. And what you can see is that you have, out of the 80 proposals, you have 50 with blockholders and 30 with majority voters. What does it mean? It means that both of those type of voters are ubiquitous. You know that they're there. You shouldn't be surprised by their presence. However, the strategic counterparts of each of those votes are much rarer. So you have 9 occurrences with sniping blockholders, 5 with swaying majority voters. You can also see that the first strategic interactions arrive later than the non-strategic counterpart, which kind of hints toward the fact that you have voters waiting to grasp an opportunity. And therefore, I'm going to consider the first of these rare strategic interactions as some news that's being unveiled about the voting base of the DAOs. All right. So I'm going to try to map a very simple corporate governance economic mechanism to the data and to see basically whether the shoe fits. All right. So this is a setup in which acquiring information about what's value maximizing for an organization is costly. And therefore, if I have a very low voting power, I will have no incentive to pay that cost. So I will either abstain from voting or vote randomly, whatever. Now, if I'm a blockholder, I have enough stake to pay this cost, and I'm going to be incentive aligned with the value maximization of the organization because I have voting power enough to pay the cost, but not so much as to unilaterally decide, basically. Of course, I can become pivotal if at the end of the governance the proposals are tight. A majority voter on the other side can unilaterally implement whatever he or she wants, including private benefiting option. So in corporate governance, you have your optimal size of the shareholder is the blockholder, basically. You want it to be large, to have incentive to pay that cost, but not so large as to have the possibility to implement private benefiting options. Out of this mechanism, you should have basically that once there's a news about governance and about governance risk that's being released, it should be released and once and for all incorporated in the governance token prices, basically. And you also have blockholders that can have a repeated impact, a repeated positive impact on the governance of the organization. However, that has nothing to do with information, because every time they vote for what's value maximizing for the organization. They have, let's say, a repeated impact on a positive growth or something like that. So you allow for that. The identification strategy that I'm going to follow is very standard event studies, triple differences and differences. And I want you to focus on the third equation, which is basically if the mechanism fits the data, you should have that only the alpha 6 coefficient is significant. So only the first time that you have a strategic voting occurrence should it affect the returns. So don't get me wrong, if you have several events, it can deteriorate the value of the firm several times, but the information should be incorporated in prices only once. And so basically the prediction is that not only alpha 6 should be significant, but every other coefficient shouldn't be. And this is exactly what you find when you go to the data. And the third column is the 11% that I've talked about before. So none of the coefficient for other type of voters and lower level interaction is significant. So I also control for DAO level controls, for DAO fixed effect, DAO quarter fixed effect. There's a lot of specification that fits. I'm going to do the exact same thing for sniping blockholders and blockholders, but this time, if the data fits the mechanism, you have this alpha 6 coefficient, which should still be significant because you have news unveiled in the prices, but the alpha 1 here could also be significant because you have this repeated positive impact of blockholders. And again, when you go to the results, that's exactly what you see. You have a lower, so you have first sniping blockholder and blockholder which are significant. And you have also first sniping voter here that's significant and positive. Why is it so? Because you have a few, this is because of a few DAOs, basically, 5-ish DAOs in the sample, for which the proposal where there's the first sniping blockholder who votes is the first proposal for which there's the first sniping voter who votes, because it's the first proposal all in all. And so basically you may have a lot of information that's being released at the same time, and so therefore for those very specific DAOs, you're not going to see the abnormal returns. Okay, so I still have 5 minutes, that's cool. So I will conclude. So DeFi DAOs first are in fact not really decentralized. So that's in line with the rest of literature on the governance of DAOs. And you have participants that vote strategically and that vote strategically in accordance with their voting power. So if you have a lot of voting power, you're going to be a swing majority voter. If you have a medium stake, you're going to be a sniping blockholder. And this is exactly as what traditional corporate governance theory would predict. Okay. You also have governance token prices that incorporate governance news about the voting base of the DeFi DAOs, and basically that incorporate the materialization of a governance risk. And again, that's exactly as predicted by corporate governance theory, because you don't have this repeated impact on the cumulative abnormal returns. You have blockholders that have a repeated positive impact on the token prices relative to proposal without them. And again, this is exactly as what is predicted by corporate governance theory. So there's a lot of hints that hints toward the direction of the final say of this paper, which is that yes, DeFi DAOs and the governance of DeFi DAOs can be a valid laboratory to study your favorite corporate governance theory, and it has better data to do so. And so now you may be asking yourself, okay, so there's news being unveiled the first time that there are strategic voting interactions. Can you kind of give us some idea of this news, of basically what's this news about? And the answer is yes, it's only in the paper that feel free to look at. I don't have time to delve into it today, but thanks a lot.
Thank you, Romain. So we now welcome on stage Andrea Canidio to discuss the two papers, and so keep your questions regarding the first paper from Baptiste and this paper for after Andrea's discussion. Thank you.
Okay, thank you very much. Thanks. Let me thank the organizer for asking me to discuss these two very interesting papers. I have 8 minutes to talk about both of them, so obviously I will somewhat keep it short. Let me start with the first paper that was presented, the one linking Tether Depegs to Cojumps in Bitcoin and other crypto assets. Okay. Now, let me start with a 3 bullet point summary of the paper before moving to the comments. So the paper does, I think, if you want to summarize with 3 bullet points, would be a very, I would say, thorough and solid strategy to identify USDT Depegs, and then identify the correlation between those Depegs and subsequent jumps in the price of some other assets. And there is an event study with only looked at BTC, and then more general analysis looking at other prices of other assets. And then a lot of let's say, interesting results related to the timing. I found particularly quite interesting the one relating the sign of the Depeg and the sign of the jump. But anyway, so it's a very rich paper with many results. Now, I found the execution of the paper, the methodology, the data collection, everything, I would say the more technical aspect of the paper, very well executed and very interesting. It's a very easy but also kind of a technical read. The one part I would like to focus on for my comments is that on the interpretation of these results. In particular, the paper uses a lot very strong causal language. I mean, even the title has spillover in it, like as if one thing causes another. And the paper tries to get to this issue of causality essentially by looking at the timing. Okay, so first something happened, then something else happened. But without providing a theory to why one thing might then lead to another, it's hard to really argue that the paper establishes a causal link just by looking at the timing. In particular, note that we are relating two things that are quite different. One is the Depeg. Depeg has nothing to do with jumps. I mean, you could have like a very slow movement in the price leading eventually to a Depeg with a jump later on. And one can come up with many theories to why one follows the other, but there's actually no causal relationship there, okay? For example, actually in the presentation you hinted at some of this, like there might be a war, there might be a war, there might be a war, and you see prices starting moving, perhaps leading to a Depeg, and once at some point the uncertainties all of a sudden result, and then there is a jump, right? So it's not even, it could also be the same asset in a sense. So my comment is that all those are very interesting facts. I will be more careful when it comes to causal language, and I will encourage to think more carefully about possible theories and test of those theories that might actually establish this causal relationship. And a final thought is that I think one thing you may want to include in the paper is that I believe during the study period that you consider on the most liquid market for BTC was actually the BTC USDT market on Binance. And I think it's actually probably still the case, and direct BTC USDT trading was minimal. So a lot of what you found might be very mechanical on the fact that, well, I mean, in fact, if you want to trade BTC in the most liquid market, you have to exchange it with USDT. So movement on one asset necessarily reflect on the price of one asset. So kind of the inverse of that is the movement in the price on the other asset. So there is this potential concern of very mechanical relationship that I think you may want to address. Okay, that's the first paper. Then if you can have the slides for the second paper. Yeah, cool. So this is Romain's paper, the one that you just heard. Similarly, for the sake of time, let me give you the 3 bullet point summary. Obviously, this is broad strokes, so paper has presentation also had many more things. So the paper has very interesting data on voting pattern in DeFi DAOs. proposal, okay, including, what I found very interesting, the timing, so when a vote was cast. And then there is a theoretical framework, not really a model, but just like a discussion of various theory, trying to exploring how certain voting behavior, if we interpret them strategically, might actually reveal new information, and to the extent that we believe in the fact that the price of an asset should incorporate available information, might then lead to a jump in the price or a movement in the prices of those assets. And those voting behavior are presence of large voter, I would say disagreements between large and small voters, sniping, so last minute voting that sway the outcome of the voting process. And then there is also very interesting and, in my view, very kind of correct and insightful distinction between the first occurrence of all these events and subsequent occurrence. Okay? And then there is an empirical test of this theoretical framework using price data. Now, again, my main comment has to do with the following. One reason why blockchain and this environment is very interesting is because we have a lot of information. Okay, this is actually Romain's starting point in the presentation. But the fact that we have a lot of information here also implies that we know what is the underlying distribution of token. Okay, we know if there are like 3 guys who holds pretty much 80% of the token versus ownership that is very dispersed, and so on and so forth. So everything that is revealed, so if new information is revealed by the voting process, it has to be relative to what we knew before, and what we knew before is the distribution of votes to start with. And yeah, I mean, one could cook up many examples. This is one that came to my mind. But suppose that in fact the distribution of votes is such that there are 3 token holders owning 1/4 of the tokens, plus several smaller token holders. And then what you observe in the voting is that there is one of these large token holder votes along with a fraction of smaller token holders. And the remaining token holders abstain, indicating they are satisfied with the expected outcome. And then, is this a majority voter event? In the way I wrote the example, probably not, but the way you would classify it in your data, yes. And in general is, given what I knew from the beginning about the distribution of tokens, what is that I learned that I didn't know before from the outcome of this voting? And so, yeah, my main suggestion would be to incorporate that into the analysis, which is otherwise I found very interesting and well executed. Yeah, so incorporate non-voters in the analysis. The choice of not voting is also strategic, could be strategic, therefore should be incorporated. Yeah, so and then a bunch of other comments that I think Wayne, you could expand or improve the paper. Does price react? You have this interesting time dimension in the voting, but not so much in the price movements. And I think it would be interesting to incorporate that also there. Like maybe it's just the posting of a vote of a proposal that triggers some movements. Maybe is something else. So yeah, look more carefully to the time dimension of the price movements. In my experience, often proposals aren't turned down, but mostly they don't reach quorum. And that's, I think, it's an interesting dimension which to look at. Yeah, and then, okay, I found that the paper was sometimes a bit unclear and imprecise. For example, you also finish your presentation talking about the fact DAOs are not decentralized, but you never provide the definition of decentralization, which is another thing that there's a lot of discussion about. So it would be good to think, okay, if given this definition, DAOs are not decentralized. You have this statement floating around like the voting power is highly concentrated, similar to shareholder general assemblies. But okay, is there some sort of reference for that or evidence for that? In the paper, you use a lot median voter. I noticed in the presentation you didn't, because that's actually incorrect. And also another thing that you improve in the presentation, but the paper is still a bit difficult to read, that you often introduce concepts that you then define pages later, and that makes it hard to understand what's going on. But overall, again, very interesting paper with some potential area for improvements. Thank you.
So we can take a couple of minutes for questions. I don't know if the presenters want to answer to the discussion. Oh, sorry. Yeah.
I have two questions. First question for the first speaker. Second question to second speaker. Third question for the third speaker. What's the impact of the Russian invasion on the markets and the reaction of the European Union? What are the significant persecution of the energy and commodity markets and commodity European countries closely coordinate their action to ensure the supply of energy at affordable price? Second question. Okay. Second question. What is the difference between cryptocurrencies and blockchains? The meteoric rise of the cryptocurrency launched by President Trump on the eve of his inauguration is the newest digital currency that raising concern. About control, are there any risks? Why isn't France no license?
I'm not sure I have the questions, but do you want to address the first one?
Yes, I'm not sure that is really the topic of my paper. If I understood correctly, it's about the provision of energy at reasonable price during the war. Well, it's hard to answer based on my paper. So I don't know, to be honest. I don't know. If I may just comment on the review of the paper. So thanks a lot for the review. I don't know. And yes, thanks, because it's mainly what the reviewer of the journal where I submitted replied. So it's really in line with what I've been trying to improve in the paper. So thanks a lot, and it's really helpful for the future of the paper. Thank you.
And Romain, also the question, I'm not sure it's really related, but
yes, so first I'm going to discuss a bit the points of Andrea. So points well taken. The idea is that if you don't have a lot of tokens and you can't bother about which, I mean, you don't have incentive to pay the cost about what's value maximizing, why would you pay? I mean, it's not very in line with the fact that you'll pay the cost to query the whole blockchain and to see the whole, let's say, distribution of governance tokens. And if you were to do so, because somehow querying the blockchain has zero cost for you, or you have it in memory, I don't know, what you would see is that exchanges are the main token holders. So you would have Kraken and you would have other exchanges. However, those never vote. So you kind of have this thing of the way in which I'm going to get information, let's say, more easily, I think, if I want to inquire about the governance of a DAO, is to see on its forum and to see on its vote. If I go through the trouble of querying the blockchain, which to me it's not easy at least, then I mean it's not very in line with the fact that I have little tokens to invest in the DAO. But for other points, very well taken. Thanks a lot for the comments. And so for the question, what I got from it is what's the difference between crypto blockchain and a coin like Trump coin. Basically, I'm going to answer to that. And so blockchain is going to be the infrastructure upon which you can trade the cryptos. And the difference between all of that and Trump coin is that there's actually some, let's say, innovation, and there's a product that's being launched for DeFi DAOs. They aim really at having this financial intermediation on blockchain, and therefore they also aim to have token holders, or let's say shareholders of that firm, whereas Trump coin basically unveils nothing, and therefore it's purely a speculative asset.
Thank you, Romain. Do you have a couple more questions before we move to the next presentation?
I have a quick question to the second talk. Is there any suggestion after your work that the voting should be organized differently? Maybe votes should be sealed, or maybe we could call the voters in decreasing order of their size or their voting power. Is there any kind of algorithmic trick you could play to have an impact on how decisions are made?
Yes, so since the time of the sample, actually, it has gone into two directions. You have advocates for both. The first is exactly what you say, to have some kind of either sealed vote or to have, let's say, a magic formula for the voting power that makes it so that it's more decentralized. And there's a lot of researchers that do research on that, to have, let's say, the optimal voting rule in the context of DeFi DAOs. You have also the second team of DeFi DAOs, let's say, that implement things that are more and more alike corporate governance. So think of delegates, think of exactly votes being sealed, or you vote on many things at the same time. In fact, the platform from which I queried the data, I said that it's very important until 2022, because in 2023, they implement the possibility to hide the scores, basically, during the vote. And they implemented that following DeFi DAO's requests. So you have a bit of both that's happening, yeah.
Thank you, Romain. I think we can move to the next presentation by Vincent Danos. I'm happy to welcome him on stage. And he will talk about on-chain optimal aggregation of Uniswap v3 position clones. Sorry.
Thank you. So it's a team of 4. It's not quite a DAO, but I have 2 co-authors sitting over there. You can talk to them after the talk. Santiago in particular knows about the data. This talk has no data at all. It's purely theoretical. But it's after catching some kind of value which follows from some form of market inefficiency, and so the data aspect is super important, of course. Because the value I'm going to show you may be very small or large, we don't know yet. So, a few words about decentralized finance. The most of the volume that's traded in decentralized finance goes through what's called an automated market maker, or AMM for short. So I will actually define that later in the talk, but let's say a few words. An AMM is a little trading machine. It has reserves under its control, and whenever you want to trade against it, it will compute how much it gives you as an output given your input. Most of the volume goes through AMMs, and most of the AMMs are actually of one given typical format, which is the Uniswap format. So, and there's a lot of overlap. We can wait maybe a few seconds here and think about why it's like that. And it's probably because in the world of decentralized finance, the code is open source. It's very easy to clone. There's no barrier to entry from the regulation point of view. So you see how this is going to lead to multiple repeated cloning of the same initial design. And we're going to take advantage of that. So one direct consequence of the fact that it's very easy to clone is the fact that markets are very fragmented. So if you want to buy some X with some Y, there are so many different places where you can do that. So many different AMMs you could send your input to. And so this creates complexity. It's tricky to know where you should trade. And in fact, you should not trade at any given particular place. You should actually split your input across multiple such AMMs. And how should you do that? So I'll come back to this. But a second consequence of this many market on which to trade the same pair phenomenon is that you have a special kind of actor that's called an aggregator, which will offer to you as a service the possibility to simplify the market for you. So essentially, it will build an illusion of only one market per pair, and if you want to trade, you talk to that service, and that service will actually execute your order in an optimal or nearly optimal way, and share part of the outcome, the output with you. But they need revenue, right? So they're making money out of the complexity, out of the fragmentation. So one thing I'm going to do next is look at where the value is that they're taking and how we can ourselves build some kind of mitigation for that. So, or in other words, is re-intermediation a necessary evil, something we have to live with, or can we recover part of the value that's lost in this re-intermediation? So on the right of this slide, you have the first little frame is a bunch of clones of Uniswap. They're pretty, there's quite a lot of them, and they're overlapping on so many pairs, so they generate the complexity. And below, you have half a dozen or more of aggregators. So they're also there to manage the complexity. So this is really happening. So let's look at what one aggregator, taken among many, is actually doing. It's computing some kind of complex execution plan. So here's how complex. So here I was facing the service, which is off-chain, and I'm saying I'd like to trade a large amount of ETH, and against DAI, please give me an execution plan. And we see that there are over 25 swaps where you want to trade X for Y. This is the routing plan or the execution plan that that particular aggregator, ODOS, will give you. So first remark, there's a concrete manifestation of the fact that there are many markets on which you can trade the same pair. Second remark, all the trading places here are actually clones of Uniswap. So that's what we said first. This is a concrete illustration. So where we're going to look for the missing value or the lost value is on that particular pattern. So on the bottom left, you see I've singled out a bunch of swaps. They're all trading the same X for the same Y, but of course they correspond to different AMMs. So you have this kind of layered structure, and the wider the layer, the more input into that particular trading venue. So let's look at it from closer. So what is the aggregator doing for you in this kind of situation? You give it a budget, Y, and it's going to split it into many little slices, Y1, Yn, inject each of the shares into the corresponding venue and collect the output, so as we hope to maximize the output given your budget. So this is the theory, but in practice, when you run this kind of execution plan, and in particular those little splits, like you see here, there's many here, probably about 7, what's really happening, to understand what's really happening, you have to look at how it unfolds through time. So here's a time representation of what's happening. So let's spend a minute to understand where the value is coming from. So we are trading, or we ask an execution broker like ODOS to trade for us, and it's time T0. So we say what our budget is, and we say what is it we want to trade it for. ODOS, or the aggregator, or ourselves, if we know how to, will compute some kind of optimal execution plan. It's computed at time T0, and it's computed, most importantly, against the state of the chain, of the world, or that part of the state that matters, which we can observe at time T0, or nearly T0. So this is what I write by the output X, depends on the time at which we design the plan, and on the state which we observe at the time we design it. So once we've designed our plan, we execute it, but that's going to take time. So we have to send a bundle of transactions to the chain, and it's finally executed at time t1. The larger the latency, the delay between t1 and t0, and the more amplified will be the difference between the expected outcome, the one we computed, and the actual outcome, the one we get when you execute. It's actually not just depending on the delay, but also on the intensity of the event process that's taking place between T0 and T1. Even if you have short delays, if it's the medium, the chain is very active, then the state can move a lot, and so you have a discrepancy between the two. This is the usual notion of slippage, right? So this is not what we're interested in, because that slippage, unless you know the future, you can do nothing about it. Sometimes it's positive, in which case the execution broker will keep the difference, of course, that's how they make a living. Sometimes it's negative, and then you take the bill. It's the oldest trick in finance intermediation. What we're interested in is comparing the actual output with the output you would have had if you could compute your execution plan at T1. That sounds impossible because there's latency. But we are not in traditional finance. We have a blockchain. So it is conceivable, at least, and I'll show you it can be done actually, to write down a smart contract which will solve the optimization problem on-chain before to actually shoot a series of transactions to the target AMMs. And so by definition, if the splitting contract is optimal, it will realize more outcome or more output, will have a better outcome than the one that you actually realize by running your old execution plan. Okay, so this is exactly what we're going to do. So we want to run a splitting algorithm on-chain. And one precondition that makes sense, on-chain is a very computationally restricted universe. You have to be careful about the operational costs. You have not that much compute at hand, and it's costly. And in particular, the costlier part of running a contract is not the maths. That's actually quite cheap. What costs is manipulation of the permanent memory of the chain. It's the space complexity of your algorithm that you have to constrain, reduce as much as you can. So that algorithm that I'm going to present is optimized for asking the minimal number of questions, so reading the minimal amount of permanent memory on chain so that it's small enough to fit as a contract. All right, so now I switch to the second part of the talk. I have to describe what an AMM is. I'm not going to describe AMM in general because, there's just so many different types, even though most of the actually used ones are of one type. I'm going to define a certain class, which is much broader than the Uniswap type, and that's the one we're going to work with. The way I'm going to describe it is by describing the building block first. So this is quite a new view to AMM, so we have to take the time to explain it. And then I looked at AMMs as superposition of those building blocks. So let me present the first Lego brick, if you wish. Each AMM of the class we have in mind is a superposition of very simple objects that are called priced parameterized AMM. So what's a PPM, priced parameterized AMM? It's two curves, smooth, defined on the same range. A minimum price to a maximum price. The red curve is the supply curve, if you want. It's the schedule at which the AMM is going to sell the asset it's selling. So for example here, I've taken a linear schedule. So what does that red curve mean? It means the liquidity provider is willing to start selling at 50 and then to sell linearly until it has no inventory and stop at 150. Incidentally, this is actually empirically a very clearly observable pattern of liquidity provision on order books. When people provide liquidity, market makers, their supply curve is mostly a linear interpolation between two prices. Of course, they move the prices a lot very quickly, but they think in this way. Surprisingly, there is no AMM that implements this simple schedule. I'll show you next slide how it looks like if you look at the Uniswap type, and it really doesn't make much sense. This is much simpler. It's empirically observed, and also just simply very natural. Now let's talk about the demand curve, the green curve. So that's the amount of the other asset you have in your reserves as a function of price. And so the supply curve here is represented as a decreasing function because it's represented from the point of view of the AMM. So as the price goes up, you have less and less and less of the asset you're selling. That's why it's a market-making machine. And the other one, dually, you have more and more cash, if you wish, as the price increases. So you need these functions to be smooth, to make a nice theory, to be defined on the same range, one to be decreasing, the other increasing. There's a last key ingredient to the definition, which is that little differential equation here, which, so y prime equals p times x prime, which, if you think of it, just articulates the fact that the parameter of these two curves is actually the price. And therefore, the name price parameterized AMM. All right? So on the bottom right, you see a little graphic representation of how you trade with such a machine. So let's walk through it together. So the machine receives a certain amount of y, delta y, which means its reserves will go up the green curve. You just invert that curve. It's increasing and smooth, so it's a bijection. And you extract the new price, Q. That's the new internal price of the AMM. And then you apply the other curve to that price, and you get the new amount of reserves of X you obtain, and which has decreased because the price has gone up. You've sold some of the X, and the delta between the two positions, which is materialized by this downward red curve, that's the amount of X that you should give to the trader. So, you know, very simple way to articulate a liquidity provider position or an LP position. And it's absolutely key to the algorithm, and I'll demonstrate that in 2 slides. So let me give you 2 examples. So that's the linear scheduling example you've already seen. On the right-hand side, what is it? It is the Uniswap PPM. And there are many others, of course. In the course of the end of this presentation, I will single out a subclass of this very broad class, which is makes sense mathematically, but not so much in concrete circumstances. But both would be in. All right, so now let's write the algorithm that we have in mind, but in the very simple example where we have 2 supply curves only. So 2 sources in between which we want to split optimally. Here you go. So you have a blue supply curve, source number 1, and a red supply curve. Here I write them as increasing function because I use the point of view of the trader. So I'm the trader, and this is like an auction. I have a budget, and where should I buy and how? So if I'm willing to pay less than 50, there's nothing. So I have to pay more than 50 per unit. So in between 40 and 70, I can use the blue curve. Why should I buy from the more expensive guy? So I buy from the cheaper guy. But when I reach 70, then clearly I have to split between the 2. Now you are going to ask in which proportion they are now suddenly the same price. Well, in the price space representation, it's trivial. You just have to buy continuously at the same price from the 2 sources. So what's the algorithm? It's just writing down a vertical line that starts at 0, moving into price space along the x-axis, and stopping right when we have spent the total budget we had at the start. And that is, by definition, the maximal output that we can get from these 2 curves. And the algorithm I'm going to show in 2 slides is exactly that, but generalized. So why do we need to generalize? So this is the third part of the talk. So yet another little jump in the cognitive space. An AMM is not just one PPM. It's a superposition. And you may superpose half a dozen of them, maybe 100, maybe 1,000. So let me show you how it looks like. This is a very deep and liquid pool of Uniswap. And you see that you have probably several hundred LP positions that are superimposed to obtain this depth curve or liquidity curve. So how does that work? A bit of algebra, but just with drawings, so it's going to be very simple. So what we do algebra on the space of ppms. Specifically, we split them and we sum them. So here I've taken 3 positions. They are defined on different ranges. So the first operation I do is I split them so that they all fall in line on the subdivision, on the common smallest subdivision. So that gives you this. I've sliced them. Then now I have a situation where in between 2 subdivision points of my price axis, I have a bunch of ppms that are defined exactly on the same range. They are parameterized curve, so mathematically I can sum them. So that's what I did, and I obtained this object. Now, this data structure is a model of the actual data structure of the Uniswap version 3 contract. It's never described like this, and actually I don't know who is aware that this is happening, but this is happening, and you can do it with any kind of additive price parameterized AMM. I don't go into the details, but there are far many more than just the Uniswap type. There's the linear type I've shown you. We've played with others. Okay, so here's the algorithm. Very simple. Here I've explained it with 3 sources. They are structured like superposition of ppms. So you start by asking your sources, give me your current price. So I've ordered them P1, P2, P3. These are my 3 sources. I start at P1, just like in this simple example. Then I move to the next price. What's the next price? It's either a subdivision price, which means I have to query the corresponding source to ask what are the new parameters. So I push, first step. Then it can be also the price of another supply curve. So I push to P2, that's the second step. Then again, I push to P3. Now I have 3 sources I'm drawing to. First one, then 2, then 3. And then finally, I may try to push to the second subdivision price, but maybe I run out of budget, which is the example I have here. So then I have to solve by hand the remaining equation. All right, conclusion. So this can be packaged into a smart contract that's going to aggregate on-chain Uniswap clones, and actually a far larger class of AMMs that don't exist yet, but I think they should exist. It asks the minimum amount of queries, and it can do that because it operates in the space of price, not in the space of quantity, like which is the most common way to deal with AMMs. By the way, just for those who know, AMMs are usually presented via invariants. If you have the price description, you can go to the invariant very easily. So the recipe works for many formats, Uniswap included. The last step where you solve can be done analytically if you know that all the sources follow the same additive format, so which is the case in the application. I've not talked about fees, they're super important. The key argument here is what's sometimes called the Gibbs lemma in convex optimization, is that you should buy from all the sources at the same price, same marginal price. But there are fees. So the same marginal price for you, the user, may not be the same internal marginal price for DMMs. You have to deal with this. It's a bit headache-inducing, but it can be done. So 2 things. We should do data to see how big that value is, data analysis. And the second thing is you may or may not know that there is now Uniswap version 4. And by design, this new design doesn't change the underlying PPM, AMM structure, so that's the same. But what it does, it incentivizes people to create many more markets for the same pair. So this means that the problem of many markets for the same pair is just going to increase. So we expect that the mitigation that we propose will be even more relevant. Thank you.
Thank you very much, Vincent. I think we can move to the discussion and we'll take questions afterward. Yeah. Thank you. I'm happy to welcome Michele Fabi for the discussion of this paper.
Hello, test. Yeah. Okay, so hello everyone. Thanks for the presentation. So yes, so I will essentially summarize the paper and give a bit an overview of what I think should be done to perhaps push this work to completion. So to summarize, so this is a paper about aggregating Uniswap v2 trades, and since liquidity is fragmented in several AMMs, it's useful to have aggregator mechanism. And the goal of this paper is to find a simple on-chain algorithm that can split the order among multiple AMMs. And essentially, the contribution of the paper is to propose a push and solve algorithm that provably achieves this goal with, solves the maximum with a very low number of operations. So, my view on this paper. So, I think that the research question, it's very interesting, but now it's reaching the point where, so it should be published, so I think I'm in the position to make this sort of comments. And I think that there is still some work that needs to be done to reach publication. And I think that the authors also acknowledge this in the paper as well. So I think these are the points that needs to be addressed, and if these are addressed, then I think we can call this paper complete. First of all is the study of transaction fees, part 1. Second is the application of the algorithm to popular AMMs like Curve, because mostly it does Uniswap, but Curve it's another popular one. And the most important from my point of view is that I think that in the paper there is no proof that the algorithm works in an adversarial environment. So what if after your choice of trades there is some adversary that tries to sandwich the transaction? And this is something that is typically done in computer science paper that does this sort of optimization, and I think it should be done. So my suggestion for the authors is to try to see if the proposed algorithm achieves robustness against adversary and to put the proof. So from my perspective, I will give some clue on which approach to follow. And now, following discussions in like machine learning conferences, so as the speaker said at the beginning, the problem of routing is really complex and it's a big optimization, but the current trend is now not really to even look for the optimal, because sometimes it's just unfeasible, but to do something that, okay, it's good enough, but we can compute. And this approach is called online convex optimization. And so instead of maximizing the function, the algorithm aims at maximizing what is called regret. And essentially regret is the difference between the sum of loss functions implied by the algorithm and the best fixed action from time zero. So that's the definition of regret, and that's the online convex optimization setting. Each period, the policymaker, the optimizer, chooses a point. After choosing a point, receives a loss function, so the optimizer does not know the loss function before solving. And then, after this repetition, computes the regret. So, and instead of achieving a maximizer, this algorithm should achieve sublinear regret, that in the sense, the cumulative, that difference should be sublinear, and typically is in order square root t, which means that on average, the term on each iteration of the algorithm, in the regret of each iteration, it goes to 0. So a typical algorithm I think the authors could prove the algorithm whether it achieves some guarantees in this setting, but the typical one, which I know a bit in a project that I'm working on, is online gradient descent. So essentially, an online gradient descent is very simple because each time you run your algorithm, you take an action, you observe a loss, and you make a gradient step, and that gradient step determines the next action. So it's just online gradient descent, but the twist is that it's applied point to point. Each time you run the optimization, you run the next step of the gradient descent. So you don't use the full data sample. So this online gradient descent is nice because it is proven that if all the agents, so if in a multi-agent context, everyone runs this algorithm and the loss function is convex, then each agent achieves no regret. So what we can say from the game theoretical point of view, now there are many well-known results on this procedure on games with finite actions, but we have also theorems for continuous actions. And in particular, if we have in a minimax game, that is the typical one in computer science, when like an optimizing agent plays against an adversary, if the game is convex concave and both players choose this algorithm, then the average action is a Nash equilibrium of the stage game. And more generally, if the game is strongly convex, the last iteration of the game is a Nash equilibrium. So if you are interested to dig in this, so this can be, I'm not sure that it can apply to your setting precisely, but it's a starting point to think about this thing. And if you're interested to discuss with me about this, I leave some reference that I can leave in the slides. Thank you.
Okay. Vincent, maybe. Thank you very much. Vincent, maybe you wanted to address.
Thank you. So, adversarial environment, the last question you're raising, this is all super interesting. But the way we think about it is ODOS actually creates bundles of transactions. I've shown an example. And they use splits. So we are improving unconditionally whatever the environment is. So this is the beginning of an answer. If we go through the online, on-chain, real-time optimal splitter compared to what they do off-chain. This doesn't, I mean, your question, I don't want to, skirt or brush away your suggestion. It's very interesting. But from that point of view, it's already an achievement to improve on their performance, and ODOS, or all the aggregators or solvers from CoSwap, are probably incorporating this kind of adversarial behavior in the way they formulate the execution contract. Maybe they bribe the sequencer to be first, I don't know what they do exactly, but that's already included. So that's a partial answer to what you were saying. What were the other 2 points? Can you remind me?
Yes, so adding the fee was the first one, and the second one was to show that the methodology works for curve.
Right,
yeah.
So adding the fee is something we have not in the paper, but we know how to do. We have it in the implementation, and actually the good news is we can add the fee structures that are quite elaborate. We don't have to have a fixed fee. For example, the fee can depend on the amount of price shift, for example, that you can accommodate with the exact same techniques. So it's not in the paper, but it will be. We've been telling ourselves we should write it for a while, so you're absolutely right. Curve. Curve is a pain in the neck, because curve does not fit in this kind of aggregation on chain. Because to deal with curve, you really have to compute with curve at each input. So curve has no explicit formula, there is no workaround. So it seems you're really back into some kind of normal convex optimization scheme, and I don't know how they do it off-chain, but it must be quite computationally intense. So, and I expect that this is what the data analysis will reveal. Curve is not so ubiquitous in this kind of execution plan. If you use stable swaps, yeah, sure, you'll find some pieces of curve. It's an AMM that's specializing in, not exclusively, but specializes in trading USDC against USDT and this type of stable swaps. So we could bring to the subset of the swaps that don't go through curve an unconditional improvement in exactly the same way.
Thank you very much. I think we are already a bit late for the coffee break, so let's give a round of applause again for all the speakers. And I think we can now move and continue the discussion if you want in the coffee break rooms. Thank you all.